let's start with what I hope is an easy one for all of you. Tell us a little bit about your organization. Who are you? Who do you serve? And what was your aha moment when you realized the importance of measuring financial health? And we'll just start with Sherry and go down the line.
Good morning, everyone, and thank you so much for having me on this panel. It's a pleasure to be here with you all today. Justine Peterson is a CDFI. We do primarily small business lending. We also do consumer loans, credit building loans, and auto refinance loans. Our aha moment is really part of our DNA. So we've always looked at credit building and helping clients to build a strong credit profile as part of our mission. Really, we look to help our clients to transition to mainstream financial services and banking and lending. And so looking at that credit score and profile is important because that's what lenders are looking at. So our first touch with all of our clients is we pull a credit report, we talk to them about what's on it, and help them to create a credit action plan that aligns with their household budget in order to build that strong credit profile. And then we pair our credit building loans with consumer loans. So with the consumer loan, we either create a line of credit. A lot of our clients are thin files, so there's nothing on their credit report or just a few lines on the credit report. So we want to demonstrate the ability and willingness to pay. We also use our consumer loans to pay off higher priced payday loans, auto loans, in order to help our clients to have more affordable payments, but also establish that line of credit on the credit report. So why is this important for entrepreneurs? Well, most lenders, most banks, credit unions, they're going to pull a personal credit score and report prior to making a lending decision. So we need to make sure that the personal financial balance sheet and financial statement are in alignment prior to building the strong business financials. But also a lot of entrepreneurs capitalize their businesses on credit cards. And if our clients can qualify for a credit card right now at intake, there's usually not a lot of space on that credit line, and they end up maxing it out really quickly. So building the credit report, the credit score, helping them to access credit cards that have a higher credit limit, and then eventually small business loans is really the portion of financial wealth that we're really looking to build.
Good morning. Oops, sorry. So building on what was just shared, so we're also CDFI, small business lender. We only focus on small business lending though, so we don't do anything on the consumer side. I thought I'd just share a little bit about the profile of who we serve, just to give you a sense of that. So in our case, because we're headquartered in New York, 80% of what we do geographically is sort of in the New England, Northeast, and Southeast area. So almost think East Coast. We cover the country, yes, but 80% of the dollars and the people served are where we have in-person networks. Revenue size for our clients, maybe $300,000. This is the average. I don't have the median with me, but about $300,000 per year. And the majority of who we serve are somewhere between 3 and 10 years in business. So then, we do serve some that are earlier stage, and we serve some that are later. But I'd say it's that kind of muddled middle of business owners out there. We have a pretty broad diversity in terms of ethnicity of borrowers, and in terms of gender, it's 60-40, male-owned, female-owned in terms of businesses. So that's just to give you a little picture of who we serve. The aha moment, for me personally, I'd say it wasn't so much a moment as much as kind of an accumulation of observations. At another gathering, I shared this before, but on a personal note, from when I was a kid, that first question, do you spend more than you bring in, was an aha moment for me, helping on the family side. Hey, Mom, you know what? I figured it out. I know why we don't have funds. Why? We were spending too much. It sounds obvious, sounds simple, but if you, it's so basic. But behaviorally, what that can do when you change that means a lot. And business owners don't always understand their numbers. They don't always understand the net, I'll just say. What comes in, yes. How much saves, yeah. But where did you spend the money? Where did it go? That tracking doesn't always happen. So going back, as an organization, I think the aha moment for us was having something that could really articulate our why. And it was holistic enough to give us sort of not only a compass, but a roadmap as to how we get there. But it was through a series of observations. I mean, we saw in 2008 what real estate means to people, right? We saw through all the storms before they weren't as frequent as now, but we all remember the Fed study about emergency savings, right, and how little there was. We all saw the public outcry in terms of income and the $15 an hour. I mean, these were big movements. The Occupy Wall Street, where we're headquartered. The notion of income disparity and the gaps. And so you take all these things over time, and we had launched an effort in 2018 to try to address, at that time, what we were thinking of as more of an income wealth gap, but it goes beyond that because there's facets. And so the aha for us was, how do you pull and tie all this together so that you're not just focusing on one aspect, but that you're looking at the person holistically? And that for us is why this particular score was useful. It's a guide, it's a framework. We've built on it in other ways, and we'll talk about that, but a great framework and a guide to our why after seeing over many, many years all the challenges that Americans are facing.
Right on time. Good morning. So I'm Bulbul, California-based. Pacific Community Ventures is half a CDFI across California, also in the small business space, and the other half of our work is a research and innovation and national mentorship platform. And I think between who we serve and our aha moment are pretty tied. So PCV was incubated out of a traditional venture capital firm in Silicon Valley. In the first 13 years or so, we did equity investing into small and growing businesses that were creating good jobs in the community. So we always had that in our DNA. And as one of the country's first impact investment funds, the measurement of those good jobs was also always in our DNA. Brands like Timbuktu messenger bags and Equator coffee, and I think I saw some Timbuktu bags yesterday. But what shifted as the Great Recession hit, PCV decided and saw in its portfolio that the bulk of the small businesses we were investing in were really looking for patient recovery working capital, and not high growth expectations again, not necessarily dilutive ownership again. And so that was really one aha moment where they pivoted into becoming a CDFI small business lender across the state. The second aha moment really came after that, and about 5 or 6 years ago, I joined PCV 5.5 years ago. I grew up in an immigrant entrepreneur family. Some months were good, some months were rough. A little bit outside of New York. And when, before PCV, I ran my own small business consulting firm for a few years. And as a woman of color solopreneur who was like slowly, steadily growing my business, I also very vividly remember that there were not only good months and bad months, which definitely caused a strain financially on my marriage and, who's subsidizing whose career, but in the effort to also pay my 1099 workers as I was trying to make sure they were with me loyally over the year, I was undercutting myself to make sure I was paying them well and a premium because I wasn't covering benefits yet, so for them to be able to access benefits. And so when I came into PCV, part of the questioning around who do we serve and how do we serve them if what we care about is good jobs outcomes that lead to measurable economic mobility outcomes and racial, gender, wealth building for folks who have not had access to economic mobility or wealth building in the same way. If we are measuring the good jobs and financial health outcomes of the workers, why are we not asking the small business owner about where they are in their financial health journey? Because I know intimately that if that small business owner, founder, entrepreneur, if they are not paying themselves a living wage, if they are not able to access benefits, if they're not able to save for their retirement, et cetera, they're not going to be able to sustain the economic mobility or financial health improvements in the business for the rest of their workers, right? So why are we not asking the business owner about their journey? And I think that really fundamentally started to shift, one, how we measure good jobs at PCV, the questions we ask in our annual impact report, our new one's launching tomorrow, the questions we then, the way that our capital is designed is with the small business owner, right, or owners. And so the first point of intervention is how do we help them? How can we support them? And those questionings really redesigned our strategy to what we call restorative capital, because if they are experiencing extractive rates of debt, even from CDFIs, and they're paying back everything they're making, they're not building a margin in the business to invest beyond the next month and the next month. And so the efforts to bring down our costs of capital to be restorative is very intentionally named so that we're literally building in margins in their P&L to help them make better and better longer term decisions for themselves, their business, and their workers. So I would say those are our two major aha moments.
Hello, everybody. I'm Justine. I'm from Neighborhood Trust Financial Partners. I'm thrilled to be following on some of Bobo's themes. We at Neighborhood Trust are a national 501c3 nonprofit organization that comes out of the credit union movement. We were founded to create Neighborhood Trust Federal Credit Union, a small credit union in the Washington Heights neighborhood of New York City. But today we're a national nonprofit with a financial coaching platform that's delivered B2B to C. So we sell our services into employers, benefits providers, workers associations, and inclusive financial services organizations so that we can intentionally help workers who are struggling to achieve financial health. We have a particular North Star of worker freedom from debt, and we serve about 10,000 individuals every year. And I was going to, bear with me, say that we actually had sort of 4 in sequence aha moments over the last decade that really converged on this focus on freedom from debt, guiding how we measure impact in Neighborhood Trust. So specifically in terms of the statistics around workers working hard but struggling and structurally unable to make ends meet, that was the first aha moment, that when we talk about financial health, we need to be talking about the nature of work first, and recognizing the structural reasons why individuals are unable to get by. It's because of that job and that income stagnating and being more variable compared to the skyrocketing costs of housing, education, healthcare. So one aha moment was, it's about work. And we always say that at the end of the day, we need to sort of look at job quality along with financial health as measures. But the next aha moment is that we're a financial coaching organization. So every day we have impact by serving individuals where we're guided by their own goals, and we're examining their behaviors. And the aha moment was, the problem that we are trying to tackle is not a behavioral problem. It's a structural problem. And part of the impact we need to have is not just individual by individual, but it is about narrative change. And we examined the narrative and thought very hard around how can we actually start measuring impact and cultivating a narrative that calls out the structural reasons why people are struggling. And so that was a real aha moment. We need to be focusing on narrative change. And what that led us to was this realization that it's really about debt. That debt is a symptom, we sometimes say it's the canary in the coal mine of a truly broken economy. And we decided to examine within the context of financial health, how can we just become laser focused on the challenge of indebtedness, which is not a uniform challenge. There's myriad products, each with their own harm on individual workers. But how can we actually understand the prevalence and the pain of debt and hold ourselves accountable as a field to say, how do we actually see how to eradicate debt from people's balance sheets as a key sort of precondition for financial security and mobility? So we've been on a journey to examine the sort of the nature of various debt markets and ways in which there's an opportunity to help people get out of debt, but really as a component part of the broader financial health framework, and hoping that we can be really intentional around solving that one piece, identifying really important data that hopefully can feed into the ecosystem around financial health. The last aha moment, which was very powerful to me, is that when we started examining the indebtedness of our own clients, we serve around 10,000 people every year, we all as an organization read the book Poverty by America by Matthew Desmond, and it really struck a chord. And I wanted to actually quote it, because the last aha moment is that what we're trying to solve, I think, as a field, is not the challenge of balance sheets or credit profiles, but really the challenge of exploitation. And we need to call out the idea that people are vulnerable to exploitation for a variety of reasons in terms of US history and US policy, especially among workers of color. And if we can identify exploitation as the root cause, it also affects the data that we're gathering and the way we're thinking about impact. So what Matthew Desmond wrote is, we've approached the poverty question by pointing to poor people themselves when we should have been focusing on exploitation. Poverty isn't simply the condition of not having enough money. It's the condition of not having enough choice and being taken advantage because of that. Vulnerability to exploitation grows as our liberty shrinks, because desperate people accept and even seek out exploitative conditions. That doesn't make these conditions any less exploitative. Sometimes exploitation is simply the best bad option. So that was an aha moment. And so we've been guided at Neighborhood Trust around how do we take our entire financial coaching framework, focusing on helping individual workers achieve their own financial goals and financial health, but through this lens of impact needs to be individuals are no longer vulnerable to exploitation. One example of that is people need to be able to be rid of predatory debt and predatory financial services. And one way to avoid predatory financial services is to have good options, and to know you have those options, to feel agency, and also to have the ability to take a breath, the ability to say, like, I can actually consider whether or not this is the only option for me. So we've been actually gathering data around how to sort of measure somebody's ability to access a good product and also have agency and time as a way to see if that can help people get out of exploitative financial services into good products as one key measure of financial health.
Well, that's an excellent transition to where we want to take this panel. In addition to providing us with at least 4, if not more, mic drop moments, which we will not actually materialize in the form of a mic drop. But I do want to get into some of the details, and Justine, we'll just start with you and then work our way back. I want to hear more about how you actually approach measuring financial health within Neighborhood Trust, and then for the rest of you in your organizations. If you have gained inspiration or have used the Financial Health Network's FinHealth score, we'd love to hear about how you've done that or what role it's played in your measurement journey. But all of you have tackled head-on in your organizations the transition that Kristen mentioned at the very beginning of the session, which is how do we get from access as a goal to these really core outcomes around not even just positive financial health outcomes in terms of somebody's budget, right? But these bigger feelings of empowerment, agency, freedom and prosperity. So tell us a little bit about how you're pushing measurement forward to try to get us to be able to capture that piece of financial health.
Sure. I'll start by just sort of profiling who we serve, and it gives a little bit of a flavor of the kind of data. Oh, I know I'm so loud anyway.
I
That
got
wasn't
you.
need to even notice.
But it's fine.
But I'll use it. I'll
New Yorkers, can you tell?
I'll profile who we serve as a sort of a starting point around giving us flavor of the data we collect. So the typical person we serve is a woman of color in a low-wage job. So 60% of our clients say that they haven't been able to pay their bills on time at least once. It's usually multiple times in the course of 12 months. 93% of them have consumer debt. The average outstanding consumer debt for that individual who's making around $36,000 a year is $12,000. 62% are subprime. And this is where it gets sort of interesting. 44% of debt and collections, 40% use 2 or more predatory products. And 50% of them are spending over 20% of their income on debt and debt-related expenses. And what we're very interested in is capturing the sort of extractive nature of those products in the form of cash, and how swapping out those products helps people recoup cash, and that cash can become catalytic. So to get specific, excuse me, we have an impact framework where we essentially have, the intervention at the center is our financial coaches. Our financial coaches don't just coach. They're coaches, they're navigators, they're product matchers, they're advocates, they're enabling somebody to optimize for minimal cash out, maximum cash in. But we look at a sort of a series of 6 indicators, and the way we think about this, we sort of have a visual of like a virtuous cycle, a vicious cycle, that each of these represents a barrier to entry into a virtuous cycle of cash generation, healthy credit, access to good products, the ability to then have a healthy balance sheet, start saving and growing from there. So I'll sort of list them off really quickly. We look at the ability to access and use inclusive, affordable products, to have an improved credit score and profile, to have a healthy balance sheet, improved cash flow, reduced usage of predatory debt, and then feelings of self-efficacy, agency, and power. And I will flag right now we're measuring using a particular measure of self-efficacy. I'm particularly interested in starting to sort of evolve how efficacy can start to be measured in terms of like real power. But those are the 6 measures. We've done some research around what are like threshold criteria, and I will say a lot of this is a work in progress where we're sort of both gathering data and using that to prove impact and then iterating on whether it feels like the right threshold. But we've been very interested in looking at the CDSP, which is sort of debt payments over disposable income, and trying to understand, how much somebody's actually spending on debt related to their income as a particular threshold, and trying to get that number below 10%. Most of the individuals we serve are more in the 30% range, as an example. And maybe I'll stop there, and I can talk later about our predatory debt definition. Is that good?
I was hoping he would go next. Mine's going to make more sense after Paul.
Paul, why don't you jump in then?
We've done this before.
Thank you.
So, you said earlier the move from access or inclusion, we actually rebranded because of that. Ultimately the AHAs, the Ascend, is what we're trying to help create, and the us together. And it was for that specific reason. We were so focused on getting the access to capital, and we were happy when we could do more and more and more and more, and we didn't stop really enough to say, okay, to what end, and are we seeing people progress? So what are we doing different now? When we found the FinHealth Score tool, we now use it since around November of 2023. Every new client that we fund goes through that survey, so we have sort of a time one measure. Our loans have now gone, they used to be 3 years when I started, now they go 5 years typically. So what we look at is we're going to measure, and we're beginning now our first annual kind of cohort, annually, how does that financial health score change over time? So that's point number one, establish some kind of longitudinal measure. The thing that we loved about this score is it has 4 aspects. It has spend, save, borrow, plan. We happen to know something about borrowing, and so to build on what Justine said, the issue, not the issue, the brilliance of the FinHealth score is that it's subjective, right? It's in the eyes of the client you're serving. But we have to have objective measures. So what we do is we said of the spend, save, borrow plan, we said we're going to focus on the borrow, very similarly. And we borrowed some of the language, but we developed 4 categories of credit health: vulnerable, coping, healthy, and then something we call lendable. And going back to the other example, we didn't think about it the same way, but for us, the goal is what is non-predatory? Well, ideally, you get into the main financial system, right? Banks, traditional lenders, lower cost funders. So what we did is we created the scale based on what would it take to go from, you start with a CDFI and you end up at a bank. And so we have about 5 quarters of this measure, and we can do across our entire portfolio. We call that the Ascendus Borrower Index, the ABI. And we'll talk more about the findings, but that understanding of our clients in those 4 categories has then allowed us to customize how we engage with them. So for example, when we have clients that are vulnerable, they're just trying to build credit and credit history. Maybe they have none, maybe they have very damaged. That's a very different engagement than when we talk to lendable. Lendable are folks that have 700 plus FICO, they've been in business for a while, they should be at a bank. We're not talking to them about credit. We're talking to them about their tax returns to get ready for that SBA loan that they're probably gonna need for the bank, so that hopefully the bank takes us out, and then we do this whole thing all over again. That's what we're trying to, so we're using the score longitudinally. We've developed a new one called ABI, just on credit. That's in terms of the measurement. The other thing, and I talked about this as a framework, when you start to look at your clients, it also tells us who we can send our clients to. So I know on the planning, that's usually an area where a lot of people suffer. Well, when people have budgeting or financial planning support, I can now refer and send to our nonprofit or other partners people who have a specific need. Instead of putting everybody through the same class, where not everybody has the same need, I have like a digital footprint of, I know exactly what they need. And so I'm only gonna send to people that need the kind of intervention that someone can provide. So in this way, it's not all us.
So you as a company might share the financial health score with all of your employees to take around their individual financial health and borrow, save, et cetera. What we are looking at is, what is the small business owner doing, right? Partly because we're lending into the small business owner or owners. And how are we measuring for the attribution of what they are able to create and improve in the business? So if you just use the financial health score, you don't get to the attribution necessarily of how much is that individual's financial health improvement year over year attributable to what's happening in the business. And because the bulk of our clients are underserved small businesses, low income, the range of sort of underserved small businesses, we really want to be able to measure the first order of impact, right? What's happening at the small business, and then with their workers. So that's part of what we're now trying to complement with adding in the financial health score, a few questions. But what has happened is we also measure at intake, right? Where is someone in terms of the income they're making? What do they want to make in the business? What is their self-determined income that they feel they need to make? What are their workers making, and where are they based, so that we have a sense of persistent poverty communities and all of that sort of mapping. And then year over year, we measure those, both business financials and revenue financials, and for the business owner and their jobs and wages. And so we've been able to then design the segmentation for, okay, what are we serving who are solopreneurs, micropreneurs, small businesses who are gonna stay small, small and growing? How do we serve them better and differently, right? What are their different capital needs? What are their different mentorship needs? What numbers of jobs are they creating? What are their different than procurement needs? Like the whole range of things that's going to contribute to economic mobility and financial health and well-being outcomes. And so that has really helped us to design these good jobs journeys for different types of customer personas to be able to then use those measurements to design more and more effective journeys year over year. So that was a little bit of sort of the how we're using pieces of the score more and more, but what we have designed is much more focused on the small business owner again and what the enabling environment they're creating in the business.
So I'm going to circle back again to how we focus on the financial health metric. We really have a credit focus with the guiding principle of the higher your credit score, the less you pay for capital. Really, plain and simple, focusing on that one metric. Most of our clients do have a suppressed score. They're thin file clients. So helping them to establish that ability and willingness to pay on time is really instrumental to them being able to access capital beyond our business loans and consumer loans, but really just getting a low balance credit card or being able to rent a car or something very simple that a lot of us take for granted that do have moderate credit scores. So we have developed a program called My Credit Compass with the support of Citi. What that program is, it's a Experian portal where our clients have access to real-time information. We do have financial coaches that are able to work with those clients to better use the portal and to fully understand all of its features and the financial metrics that it provides. In that portal, our clients are able to get a monthly FICO score and credit report. They're also able to access educational materials and really quick guides to understand certain aspects of their credit profile. There's some identity monitoring, dark web monitoring, but one of the most important features is that credit score simulator. It's very similar to what other platforms have, but it's really top of the line. With that credit score simulator, our clients can drill down and say, oh, if I don't have enough money today, what happens to make my monthly payments? What's going to happen to my credit score? They can also look at what if I just pay off a credit card and don't go back and open another one, what will happen, and certain features like that. So how that is important to us is it really helps us to understand the nuances of what impacts that credit score. And this is helpful on an individual basis when working with clients, but also understanding how to design our counseling in general. For example, we offer credit building and consumer loans to pay off collection debt. And we also, we report all repayment behavior to the credit report. So if we originate a loan to pay off a collection, that initially reactivates that collection debt. So one of the things we know about what's built into that FICO score is what have you done for me lately is very important to that score. So if you have an old collection debt that's 3 years old and suddenly you're paying it off, that date of last activity comes to the forefront. We also know that taking on new debt suppresses the credit score. So we might have somebody coming to us with no active trade lines in one collection account. We pay off the collection account with a new loan, and suddenly their credit score declines. Well, in the long run, that's really going to help that credit score soar, but we need to be aware of these kind of how our interventions are impacting our clients on a daily basis. We're a HUD certified housing counseling organization as well, so if a client's looking to buy a house and that credit score is so important because it determines your financing, maybe originating a loan at that time for their business or for some consumer intervention is not the right time. So it's very predictive of how our interventions impact our clients.
Thank you. Thank you all very much. We are running short on time, so for our final round, I was really struck by the ways that all of you are using measurement in two ways, right, to accomplish two things. On the one hand, you're using financial health measurement to identify what to do, right? Like, where should your intervention be to be most effective? On the other hand, you're also using measurement to evaluate the success of that intervention and track progress over time. And those are two different use cases. I wonder, in the very short amount of time we have left, so be extremely brief, tell me one thing that you have learned using financial health measurement, either as a way to identify what to do or as a way to track progress. And I'm going to ping pong a little bit and start, Booble, with you, if you wouldn't mind, to lead us off, again, with kind of one big insight to leave the rest of the room with.
Sure. I guess if I will merge, I'll try to summarize it in one. I think you said it earlier, access to capital is just the beginning, but a lot of folks don't even have access to non-predatory capital. So how do we make sure they get access to non-predatory restorative capital, and that we are investing for the long-term decisioning? Because that is really, that headspace and active margins in their P&L is where we see the best differences. So I would say that long-term design is probably our strongest insight as far as that.
Thank you. Justine.
Yeah, so I'll just say we've been on this journey trying to define predatory debt and then sort of track it.
I think that's the alarm going off telling us that we're done, which is very funny. I didn't realize that it would.
It's very cheery.
Please finish your thought, and we'll finish the panel.
It's the best alarm I've ever heard. So I'll just say really quickly that we've come up with a definition of predatory debt that has a variety of different features, and I'm happy to share more later. But one headline is, when you think of predatory debt, there are some like obvious products that are like clearly predatory. But what we're starting to learn is for the people we care about, so individuals with low and volatile incomes, there are a lot of products that may be helpful for others, but are particularly predatory and harmful for them. And it's really important to examine very specific features of a product and then to sort of design a solution that enables those features to be sort of surfaced and sort of redesign people out of them.
Thank you. Paul.
Assuming you have the long-term and the design, everything else, I think the only thing I would add is this is going to have an implication to your people, what they do, who you need, how they do it. And I think for us, the programmatic, if I can use that word, implications of what we're talking about, are big. This is, for us, in a way, almost a business model change, because it's not enough for us to just lend. We could do that, but that's not enough. And so I'd say the people implications and the process implications and just the nature of work, the nature of the work of the teams that you're working with are going to change. And we're still evolving that. So I share this as someone that's in the midst of it, not as someone that proclaims that I've achieved it. But every time you learn something, you're trying to do something, you have to change, what you do. If you always do what you always done, you always get what you always got, right? So you've got to change. And this is not just measurement. This is change. Change for the organization, change for your people, change in the mindset, change in how you interact. And that is always the hardest part of this. Numbers are easy. People, not so much.
So you're saying hire and train more researchers. That's your big takeaway. No, I'm just kidding. Sherry.
So I'm struck on a day-to-day basis of the volatility that impacts the entrepreneurs, especially in the micro-enterprise space that we work in, as well as low-income families. But I'm also, blown away by the resilience, and I think there's so much more to learn about resilience and volatility. But I've really found that having a high credit score can help weather those storms because of access to really credit cards or lines of credit or having access to that debt, sorry, Justine, in case you need it. So that's my insight.
Well, thank you all very much. Please join me in thanking Sherry, Paul, Bubal, and Justine.